morning everyone. This is Hanif. Today, this is the second class for accountancy. Today we shall discuss about some various transactions which is affected to our partnership amounts. In the last class, we shall discuss about the meaning of partner, meaning of partnership, definition of partnership, features of partnership, and most important thing, partnership deed and its contents. So everything we have to discuss in the last class. In this class, we shall discuss about some transactions may be affected in the absence of partnership deed. So which are those transactions? If this transaction will be arises into the question, how we are going to face? So actually this question is the practical oriented question for 5 marks question, this one. So here, provisions of Indian Partnership Act of 1932, in the absence of partnership deed, whenever we have to record it, we have to joining into the partnership, we will make a deed, we will make an agreement. In that agreement, sometime, so if these transactions will be avoided or it should not be recorded in that transaction, then what is the treatment? How we are going to be utilize this one? So that thing we have to discuss in this class. So another, the first and foremost point is profit sharing proportion. In case of partnership, if they are not mentioned any profit sharing ratio or proportion between the partners, during that time we can share the profit and losses everything to equally. So all the profits and all the losses we are sharing equally according to the partnership deed. In that deed, we have to mention any kind of the information about the profit sharing, means we have to distribute the profit according to that criteria. But in the absence, means if we are not recorded, means if we have during that time we have to earn a profit, means that profit we have to distribute it equally among the partners. This is the first criteria. Number second one is a interest on capital. So in this situation, so interest on capital is not allowable or payable to any partner, because the partner is considered as a owner of the company. If the owner invested anything, means we won't give any kind of interest for their investment. Just we have to give returns as a profit, but we won't pay any kind of the capital interest in the according to the partnership deed. In the absence, means we won't pay. If it is mentioned in the partnership, means if the partners borrowed outside capital, means or additional capital, means during that time we have to pay interest, but a fixed rate, fixed margin we are going to be fixed. In the absence, means we won't pay any kind of interest on partner capital also. So another one is interest on drawing. So in case in the absence of partnership deed, any partner has withdrawn the business property, means during that time that interest is also not allowable in case of the partnership deed in the absence. And fourth point is interest on partner's loan. In case if a partner has brought loan from any financial institutions or outsiders or any other way, if he brought a loan for the purpose of business, during that time the rate is going to be fixed as per the Partnership Act of 1932, that is 6% is the rate of interest which is paid for the loan borrowed by the partner for the business purpose. So other than this, so interest on capital they are not paid. So interest on drawings also not paid. So they are also not applicable. But in case of interest on partner's loan, then it will be paid for the 6% per annum. And last and foremost provision, that is compulsory, but they are saying that remuneration to employees. If a partner has working in their own organization, he won't give any kind of salary. Here also not payable. So no salary is payable because he is not an employee. He is the owner of the organization. If owner work for their organization, means he expect only returns, that is profit, not for
salary, not for commission basis. So these are all the provisions which are affected in the partnership deed in the absence as per the Act 1932. Next important topic, maintenance of capital accounts of partners. So as per the partnership deed. So here the partners entire transaction, all the related information of partners should be transferred to partners capital account only, like the partners capital, salary, commission or any profit, any losses which should be incurred in the business, everything we have to transfer partners capital accounts only, maintenance of partners capital account. So here the provisions is considered practical oriented question for 5 marks. This one. So maintenance of the partner's capital account, meaning they didn't have, but the methods they are going to ask. In this capital account, the partnership should be maintained two types of capital methods. So number one is a fixed capital method. Second one is a fluctuating capital method. So what is it mean? What is my fixed capital method? So here the fixed capital method is a method or direct method where the capital accounts of all partners are fixed. So under fixed capital method we have the capital transactions of a partners may be divided into two types. So here we have to open or prepare two types of accounts. So another number one is a partner's capital account. Another one is a partner current account. So by opening these two accounts, that method will be called as a fixed capital method. So here the capital of the all partners are transferred to capital transaction and remaining revenue transactions all should be transferred to the partner's current account. That method is known as a fixed capital method. The second method is a fluctuating capital method. The name itself indicates fluctuate. Fluctuate is nothing but changes. So changing from one year to another year, the capital of the business or partner should be changes or should be increased or decreased by year to year. That method is known as a fluctuating capital method. So according to the examination point of view, so they have asked, so what are the methods of the partner's capital account? So this is a 2 marks question, this one. So in some time they will ask, so prepare a partner's current and capital and current account for 2 years or for two partners. For imaginary figure they will ask me, we have to prepare the account like this manner. So first we have to draw the columns for the partner's capital account. The name indicates partner's capital account. In this account we have to record a only capital transactions. The accounts may having a two sides. According to the T format, we have to prepare the accounts because we should prepare the accounts only for the double entry system of bookkeeping, not for the single entry system of bookkeeping. So under this, so first we have to draw the columns. So left hand side, right hand side, two sides we have to get. So under left hand side, we should consider as a debit side. So right hand side should be considered as a credit side. So all the capital transactions should be recorded into the capital account, and the remaining all revenue transactions that should be recorded into the partner's current account. So what are the transactions will come under partner's capital account mean? So in the beginning itself we have to transfer opening balance of the partner's capital account. We should mention under right hand side, that is credit side of our account, by balance carried down, balance brought down, not carried down, sorry, by balance brought down. So brought down in the bracket we have to mention opening balance, opening balance. So because while we have to start a business with a small amount of capital, so that capital always come to the credit side only, because this amount we have to pay later at the end of the financial year. So we have to know what is the invested capital, what is the present ending capital into the business. For the difference we want to know, for that sake always we have to record it into the credit side only. So here we won't mention any amount, just I am mentioning the into marks, x, like that I am going to implement it. So next, one more transaction we have to get. So by cash or bank account. In bracket, we have to mention additional capital. Additional capital, because in the business while it's beginning we have to invest a smaller amount. In case if the business needs more capital, means during that time we have to invest in extra capital. That extra capital will be considered as additional capital. So that capital we are not paid directly, we should pay into the cash basis or through bank basis only. Whenever we have to pay the amount to the bank basis, means it should be considered it is a legal transaction. So that amount also we should record it into the debit side of the partner's capital account. In that capital, if any partner has withdrawn the money from the business for their personal use or private use, that amount we should be debited to the partner's capital account. We should write to cash or bank account. Cash or bank account, I will mention X into marks during that time. So if any amount invested, that should be come to the right hand side. If any amount withdrawn from the business, that should be debited to the partner's capital account. And finally, we will make the balance of both the sides. Always in the partner's capital account, we will get the totals of credit side itself, the higher value. The same balance we should transfer to the debit side also, and we find out the difference amount, that is called to balance carry forward to the next account. That amount we have to return into the partner's capital account.